You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith, Senior Analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Good to be back, Jim.
The title for today's show, Gold and Silver by the Numbers. What should we be thinking about right now?
Well, all of us are in the same boat that have any kind of a position in the metals. It's been sideways to lower for about 4 years now, and if people aren't feeling it by now, then they must not have any nerve endings. But I think even though most analysts in the last few weeks have turned bearish, and it's really hard to find an encouraging word out there, I think when the markets test your metal like they're doing now, there's some things that you need to remember and look at if you're going to be successful going forward, whether or not you stay within these markets. I think, number one, you have to remember that you're more than your investments. They're just one part of who you are, and they tend to affect, if they're doing well or not, they tend to affect our image and persona, but the reality is they're just something that we do. They're not us. You need to get enough sleep, eat right, and stay shape, and that's especially important when the markets are testing you, which is what they're doing. And each day, I think it's really important is to express gratitude for at least one thing in your life that you appreciate. And you just can't believe how much better that makes you feel. And you can endure all sorts of internal and external insults if you keep doing that. And that, as I see it, the key behavior now is to revisit your investment assumptions. And basically, if you do not believe in the underlying market forces that are moving gold and silver, and you don't think that we're still in the bull market, then you probably should just get out. And I use the example of the movie that I love to watch, The Magnificent Seven, where one of the seven questioned whether he should even be supporting the other six and whether he wanted to. And the leader, Chris, said, "You don't have to do this. We won't look down on you if you ride on." And he ultimately had to make that kind of a choice. And I think that's where we are now in the markets, Jim.
What would have you supporting this? And you said by the numbers. Do you have technical support that looks like this is a good idea to start taking a look again at your precious metal portfolio?
I do think so, but before I get to that point, I'd like to just kind of follow this thread a little farther. And I think if a person that's listening to this believes that this is still a bull market and they want to participate and they'll put up with the ups and downs of it, then they need to ask themselves, why do I want to do this? And I can't answer that for anybody but myself. But you know, Jim, for me, I know why I want to do this. I want to take an opportunity to possibly improve my financial position, and so that I can keep being able to afford to add learning chapters to my life book while I'm helping others. It's really important to me. And I believe intensely that this bull run in gold and silver is far from finished. And so for the worst thing for me to do, since I believe that, would be to quit and then run the risk of watching from the sidelines while the prices potentially go exactly where I thought they would. And if you notice what I just said here, what I've done is to align my core beliefs with my market behavior. And once you do that, you can become a lot more calm, and you're able to go ahead and handle whatever the market dishes out. So I would suggest that for our listeners, that's the question that they have to ask themselves is this: are you more afraid of loss or of missing the next run to the upside? And if you quit now, and if you're wrong, I will tell you this: you will never get back in.
I'm sure you must have examples of people. Well, I'm just thinking about the last time the markets dumped. All these people are going, well, look at what's happening to all my portfolios. Everything's dropping like a rock. Let's sell now. And they were selling at prices way below what they paid. Well, for most stocks, unless most companies go bankrupt, and they don't, they're going to go up at some point. So if you hold on, we've seen people surpass where they were, but they all bailed on the way down. You have examples of people who did that.
I do, and you know, it's human nature, every one of us, and I'm sure even Warren Buffett has to deal with this. We tend to not want to buy when prices go down, and we're afraid, and we tend to want to buy when they go where we thought they would. The difference between Warren Buffett and the most of us, rest of us mortals, is that he knows what works, which is to buy something that he sees as good value in relationship to the current price, and buy that and then ride that when it turns around. And I was just reading, actually within the last day or so, I was reading a couple of pretty interesting things. I was reading on one of the website about something called Bitcoin depression. It's about people who've written in and told about how they bought Bitcoin when they were really quite inexpensive, and they sold out and then watched prices go much farther. And one guy bought it 80 cents. He bought a bunch of them, sold them at $4. Now that's about a 500% return. But then Bitcoin went to $1,000, and now it's about $475. He sold his at $4 for a 500% profit. And he is so depressed, you can't believe it. And there was one lady who ran a Bitcoin operation in Hong Kong who actually committed suicide, jumped out of a building when her investments were down. So the big swings are part of life and living, and they're certainly part of investing in the day and age that we live now, where everything is manipulated and where the internet makes it possible for information to get out there in a nanosecond, and then people act on it. Another one I read about, I know this individual, and I have a lot of respect for him. He's certainly gone through ups and downs in life, but he's a well-known conference speaker who founded a Canadian financial website during the dot-com era that went from 0 to 200 million to 1 million market cap. And he's no longer associated with that company today. He did sell out well above $1 million, but this is still one of the most lucrative, or active at least, sites of its kind on the internet. And so big swings are here, and you have to be willing and able to put up with it emotionally and financially. And of course, by avoiding margin is a big way to do that. And I'd like to give you one more example, Jim, which really takes us right up to the present day, and I think it relates indirectly and directly to the gold and silver story. A friend of mine bought physical palladium in 2005, and he didn't buy it on margin. He paid cash for a certain amount of it. He bought it at about $170 an ounce. And with the $50 premium that prevailed at the time, that means he was into it for about $220 an ounce. Well, I looked at the chart this morning to see where that had gone since that time, and he still has just about all of it. And so here's what he had to put up with between 2005 and now, which is a little less than a decade. After he bought it, the price went to $350, and so he could have almost doubled his money, but he didn't at that point. It dropped to $180, which is essentially where he bought it. Then it rose to $400, dropped to $300, went to $600, went to $180 again. So it made the round turn several times after he bought it, essentially back to where he paid for it. Now, if you're a swing trader and you're fortunate and lucky, you can play some of those swings. But what I found is if a person wants to hold something for the long term, if they try to play those swings very much, at some point they either end up getting completely sold out, or they have such a small position that they can't benefit from a really big move if what they think is going to happen does. So now that person still has his $180 palladium. It's gone up to, it went to $850, it went to $550, and now it went to $920 just a week or so ago, and now it's about $820, and the question is, where does it go now? Well, you and I have been talking, we feel it's going to go a lot higher, but the point being, he's still in the game, and he's put up with those swings. He's up about 400%, and if he's right, he may be up another 400% before this is over. So for most mortals, to try to play the swings, if you feel it's going a lot higher, it's a good way to end up watching.
David, radioactive silver, that sounds like dangerous stuff.
Well, it can be, especially if you don't have some of it. At the Vancouver conference this spring, I gave a talk titled The Case for Radioactive Silver. And a lot of people kind of didn't know how to get started on even figuring out what that was about. But here's where the idea came to me. The idea for this talk was based on a chart and a quote by analyst Gene Ahrensberg, who this spring was talking about silver, and he showed what looks like a multi-year bull flag formation where you have this long flagpole starting up from the beginning of the bull market around $5, going up to $50, and then unfurling as it dropped down over a period of several years down into where we are now, which is, we're speaking, is around 1860 or so. And he said that this chart, here's what he wrote, and I thought it was really emotive and fascinating. He said, consider the action in silver as a giant, torturous, bone-crushing, radioactive flag formation, end quote. And he noted what he called the implied massive support down to 1850. And that's where we are right now. And so if you look at a 25-year chart, there's this tremendous shelf that silver is sitting on right now. Now, that doesn't mean it can't go below it. It means it has a lot of support for right now there. And even if it were to drop, say, another $3, that would have put it 15, which is another massive level of support. And so the thing is, if you look at it as radioactive, you know what happens if you have a detonation of something that's radioactive. the fallout goes all over the place. And if silver is indeed got a radioactive bull flag formation going here, if that thing turns around, and when it does, which I believe it will, and heads right on back up again to all-time highs above $50 and well beyond, you can imagine what that's going to mean for the quality mining producers and exploration stocks, not to mention the price of the metal itself. And so what I did this morning, and this is my opinion, but I looked at I put together a risk-reward ratio of where I thought gold and silver are now and what they represent. And for gold, I came up with what a 1 to 4, in other words, a $1 to risk to $4 reward ratio. If you figure about $250 risk versus $1,000 reward, that would give you a $2,200 gold target, which would be a bit above all-time highs. And for silver, it was even more fascinating. I came up with a risk-reward ratio, just assuming $40 silver from where we are now, of about 1 to 7. So risking $3 to $15 versus $21 additional target takes you up to about 40. And then if you assume 1 to 10, which would put you at all-time highs, just a little higher, that comes out to about 1 to 10 on the risk-reward. And I believe if we get up into that area, we have a very real possibility of going to the finger spread target based off of the bull flag of about $65, and you can do the math on that one. So I really feel certainly there's real risk in here. But when you look at the reward, there are very few things in life that I can think of, maybe none, that have a very high reward potential and no risk at all.
Yeah, I was going to say, crossing the street, probably the riskiest thing you do every day.
Well, we're all here for a limited time, and some of us choose to just watch all the time, and others of us choose to go out and risk something, on the potential of maybe making a qualitative difference. And I happen to be one of the latter. And I think, it's so hard for all of us not to be afraid in the market and not to become emotional. But I think of a very interesting quote that has always motivated me, the difference between a victim and a survivor. In dire circumstances, a victim focuses on his or her vulnerability, and a survivor places their intention on their ability to respond. So if our listeners can be in that latter camp and ask themselves, how can I respond to this? I think they're going to be in a much better position than if they maintain a victim status.
And also, you're looking at some 25-year charts that gives you some confidence in this position?
It really does. I'm not self-peddling the risks at all that it could go lower from here, but I'm also saying that based upon what that chart shows, it shows the very real potential that we're staring the abject lows, give or take a little bit, in the face right now.
David, thanks a lot for chatting with us.
You bet, Jim. It's been great talking to you today.
My guest has been David Smith, Senior Analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.